No one gets rich by only saving money. No one. If we examine the lives of multimillionaires, if we examine the lives of those with generational financial wealth, we will see that many of them have their wealth coming from varying streams. They are not confined to a single stream of income. And many of them are not going to have earned income as their primary source of income. Good afternoon, everyone. I'm Dr. Severin Bryan, financial educator and coach. And today we're going to be talking about the 7 streams of income. Now, before I dive into that, I want to give a definition of passive and active income, because these 7 streams are going to be tied somewhere around either they're passive, active, and I want to throw in their portfolio income, because when the IRS look at some of these, it doesn't really classify as active or passive. It classifies it as portfolio income. So passive income is income where you're not actually doing anything. Doesn't mean you're not working. It just means you're not physically, let's say, for example, you own a rental property. That is passive income to you, because the income that you get from that property is not dependent on what you're doing. Earned income or active income, on the other end, is I have to do something to earn that income. When I go into my job as an accountant and I do my job, I get paid. If I don't do that job, I don't get paid. So my income that I get from that job is dependent on me actively doing something. So that's active income, passive income, and then of course portfolio income. I want to throw that in there a little bit. It's not often used. It's usually just 2 categories of active and passive. But portfolio income is usually dividends, capital gains, that sort of thing. But as I go through the 7 streams of income, I will talk a little bit more about active and passive and portfolio. But I just wanted to give those definitions ahead of time. Okay, so the first stream of income is our earned income. And as I said before, that is something you're exchanging your time for money. That is the category that we really don't want to be in. Because if you're in a category where you're exchanging your time for money and you get sick and your income is actively tied to you being there, for example, an hourly worker, then if you don't have another stream of income coming in, then you could be in trouble financially, because you are no longer able to actively work to gain income to supply your needs. So active income, earned income category is the least favorable category of income stream. You're trading your time for money. It's typically a W-2 category. The next stream of income, and let me just kind of put these up on here. The first one is earned income. For those who may be taking notes, the first is earned income, which I talked about, the W-2. The next category is business income. This could be passive or active, depending on how much you participate in the company materially. What do you just go in on the weekends and just kind of oversee things? Are you there day to day? Then if you're there day to day, it's possibly you could tie that to active income, because you're actually there doing the work to gain that income. But business income is where you're actually providing a good and or service in order to get an income. And you could be participating in that business materially or not. And so that income could be passive or active to you, depending on how much you participate. So again, it's earned income, which is typically W-2. Business income is the second category, and this is where you're exchanging goods or services for money. All right, the third one is interest income. And this is where you may have a savings account, and it's really considered you're loaning your money to someone, to an organization, and you're getting a return on that money. Because when you deposit your money in the bank, you're actually loaning your money to the bank. They sweep that account, they sweep that money, and that's what they're using. I mean, it's bigger than that, but for the just as a simple explanation, you're taking your money, and that's what they're using to lend to other people. So interest income is our third category. That's typically, again, from savings account, could be from treasury bonds, because you're lending money to the government. When you borrow money, or when you invest in a treasury bond, the interest that you get is considered interest income to you, but you're actually loaning money to the government, per se. And P2P, where you are it's person to person loan, where you have those groups. There's new types of financing now where you could do person to person lending, and you get an income from that. You're getting interest on that loan that you made, and that would be in this category. It would be the interest income category, or the interest income stream. And this one, again, is passive, because you're really not doing anything to get that interest. You've loaned that money, but you're not working for that interest. You get that interest whether you do anything or not. So I'm hoping that's clear. The fourth category in our income stream, or list of 7 income streams, is dividend income. And this is where you own a piece of a company in the form of stock. You may own a stock, and they pay you a dividend, and this falls into that category. So this is a good stream to have, because it's not dependent, again, on you doing anything. Maybe in the beginning you had to actively work a job to get that money to invest in that stock, but in order to get that income, you're really not doing anything. So it's shares that you own, and that would categorize as dividend income. And rental property is the and I keep forgetting to click on my slides here. Number 3 was interest income, and number 4, dividend income. And so we're on to number 5 now, which is rental income. And that's pretty self-explanatory. You're renting a property, and you're getting income from it. It could be, in this category, it could be passive or active, but for the active, your income is not dependent on anything you do, because your renter is going to pay you $1,000 a month no matter what you do. But you could be doing things, managing the property actively, but that doesn't mean that activity is dependent. The income is dependent on how you manage the property. You're going to get $1,000 whether you're a good or a bad manager. So that's rental income, is another way that you could diversify the streams of income that you get. And as I mentioned at the beginning, if you examine the many multimillionaires, the ones that have generational income, you're going to find that they are in some of these latter categories. They're not going to be in earned income, because they're not exchanging time for money. That's the least effective way to build wealth. Yes, you may need to start there and use that as your seed money to invest in a business, to invest in interest-bearing vehicles, to invest in dividend income vehicles, to invest in rental income. But earned income is the category that you want to get out of. You want to get out of that category, because you don't want your time to be exchanged for money, because it limits how much you can make when you're devoting all your time to get that rate, that money, $10 an hour, $15 an hour, $30 an hour. It limits what you can do. You want to try to get into the other streams, which are passive income. Okay, so number 6 is capital gains. And this is where you sell your shares. So you bought a share of stock, and when you bought that share, the company may pay you a dividend. That goes into your dividend income, that category. However, if you decided to sell the share, then you may have capital gains. And capital gains is, you bought the share for $10, you're selling the share for $12, you pay taxes on that $2 income that you just earned when you sold the share. If you have shares of income, shares of stock, like in your 401k or whatever, you have shares of stock, you don't worry about capital gains. The reason Warren Buffett is as wealthy as he is because he buys and holds. He doesn't sell. So he's not paying taxes on that capital gain, or he very, very rarely sells. Most of his income is based on, or his wealth is based on the capital gains. It's book gains, because he hasn't sold. He's only going to be taxed when he sells those stocks. And more than likely, he's going to just pass them on generation to generation, or if he's going to give them to charities or whatever, that wealth builds, and he's able to pass that on. He's only going to be taxed, and he only loses the benefit of that if he sells the stocks or his investments. Now, capital gains tax is typically a lower tax than your regular income tax, which I don't want to get into that too much. But when I talked about the 401, when we discussed the 1040 form, I kind of went into that a little bit more. But capital gains is where you own an investment and you sell that investment, whether it's shares of stock, whether it's an investment, or whether it's your home. You could pay taxes on capital gains. You could get capital gains from selling your home if you sell it significantly more than what you purchase it for. I mean, there are some caveats around that, which I'm not going to go into because this is not that session. But if you want to talk, have answers to those questions, you can contact me afterward. All right. So the next category is our royalties and licensing, and this is where you may have a song that you wrote, and somebody uses that. Fast food franchises, where let's say KFC, when they franchise their operation, somebody that is using the name KFC, using the brand, using the colors, using the menu, using the recipes, the business or the headquarters of KFC is getting royalties from you using or they, for them licensing that to you, they are getting royalties from that. So that's another category to consider. If you're an author, if you are somebody who's written a song or something, and you allow other people to use your poem that you've written as a song, or you allow other people to use whatever that property is for them to make money. Every time they use it, you get money from it. So again, the 7 streams of income: earned income, business income, interest income, dividend income, rental income, capital gains, and royalties and licensing. And those could be active or passive. And you want to be sure that you are getting more than you're invested in more than one category. Because if you were to lose your job, then maybe you have business income coming in. If you were to lose your business, maybe you have earned income. Maybe you have interest income from investments that you've made. Maybe you have dividend income from stocks that you've bought. So you are at all points, you want to make sure that you are having more than one stream of income. There's a saying, you don't want to put all your eggs in one basket, because what happens when the basket drops? All the eggs are destroyed. So I hope this was helpful, and I don't see any questions in the chat. Go in here to see. I don't see any questions in the chat, but I hope this was helpful to you. For those who joined late, again, I just want to run through quickly the 7 streams of income. Earned income, that's where you're exchanging time for money. Business income, where you're selling goods or services. Interest income, where maybe you put in your money in a bank and they're paying you interest on that. Treasury bonds, they're paying you, the government is paying you interest on that. Dividend income, shares you own in a company. Rental income, this is of course pretty self-explanatory. You have a building, you rent it out, and you're getting rental income from that. Capital gains, this is where you sell your investment. And royalties and licensing, this is where, for example, KFC or Subway allow you to use their name in your business, and you have to pay them a fee for the use of that name and their colors and their recipes, etc. So I hope that was helpful, because what I see happening is a lot of people do a lot of earned income, and they have 7 ways they have earned income, and they say they have income stream, but that is completely different. You have 7 sources of income under the earned income category. You don't have 7 streams. Your streams are different types of income that you can have based on how you invest, how you have businesses, how you're set up, how your portfolio is set up. So I hope this was very helpful. You can contact me if you need to discuss this further. You can contact me on my website, which is sebtalksmoney.com, and you can set up an appointment to discuss anything that you would like to discuss around this topic. And I'll be more than happy to do that. Again, thank you so much for taking time out of your day to meet with me here at 4:30 p.m. Eastern Time every Sunday afternoon.